I've worked with hundreds of tech founders, and I keep seeing the same types of insurance mistakes being made that I think are worth talking about because these are simple, avoidable mistakes, and if left unchecked, they can destroy an early firm's future. I'll break down what I see as the big 3 deadly mistakes tech founders make with their insurance, and if you stick around to the end, I'll also share 2 bonus mistakes we see all the time that can be just as costly. Hi, I'm Gordon Coyle, and for over 40 years, I've been working with business owners from every industry to get them the protection they need today and into their futures. Business insurance can be complex and confusing as well as costly, so we take the time to explain it and break it down so you know what you're covered for and what you're not covered for. In addition, our broad access to the marketplace assures you're getting fair and transparent pricing. If you'd like to work with us on your business insurance, we'd love to have a call. All right, so one of the verticals we specialize in is tech, and we've seen these mistakes cost founders everything from losing million-dollar contracts to putting their personal assets on the line. And I want to make sure that doesn't happen to you, so let's get started. Deadly mistake number 1, the enterprise contract shock. Picture this, you've been grinding away for 3 years. You finally land that meeting with one of your dream enterprise level clients. The contract comes through, you're ready to celebrate until you hit page 47, the insurance requirements. That $600 startup insurance package you bought doesn't even come close to satisfying these requirements. Big clients require big policies. They want robust, multi-layered policies upwards of $5 to $10 million in limits. Now what do? Here's the problem. Satisfying those limit requirements will eat into your profits as they weren't built into your budget. And it could take weeks to get all that coverage in place. Meanwhile, your competitor, they already have the coverage and can sign that contract today. The point is building the right insurance program and scaling it as you grow so that you're ready to win the big deals is critical. If you can't afford to win the contract, you're not ready to win the enterprise client. Insurance can't be an afterthought. It needs to be built into your growth roadmap. How do you do that? I think it starts early by asking yourself, who is your ideal client in 18 months from now? And then working with us to build your insurance program appropriately around those expectations. Okay, deadly mistake number 2, the cheap policy trap. And this one might surprise you because it goes against everything that you may think or know about buying insurance. You're a tech founder. You see InsurTech with their sleek interface, fast quotes, good branding, and you think, finally, someone who speaks my language. Plus, buying direct has to be cheaper, right? No middleman taking their cut. Well, there are actually 3 false assumptions here, and they're costing you money and leaving you exposed. First false assumption, they're tech savvy, so they understand my tech business. The reality, being good at building software doesn't mean they understand your specific risks. Can their platform customize policies to your specific needs? Do they have the capacity to build up the limits for that enterprise client we just discussed? Probably not. Most of these platforms are pretty cookie cutter. Second false assumption, and this is the big one, cutting out the middleman saves money. Here's what most founders don't realize. Specialized brokers have relationships and negotiating power that these platforms just don't. We negotiate on your behalf. They're just selling you a policy. Let me give you a real example. Last quarter, we took over a tech client's insurance program from one of these popular insurtechs. On the surface, they thought they were getting a good deal. But when we dug into their coverage, we found some serious gaps. Their cyber policy, it only included $50,000 of social engineering fraud. The industry standard is $250,000. Think about that. If you got hit with a wire transfer scam or a CEO fraud email, they were underinsured by $200,000. We restructured their entire program, closed those gaps, and saved them 30%. That's not unusual. That's what happens when you have a specialized broker who actually negotiates on your behalf versus a platform that's incentivized to close deals fast. Third false assumption, a quick online quote means I'm getting the right coverage. Speed is great, but fast quotes often mean policies are designed to protect capital exposures, not the operational reality of your specific business. Here's what you need to understand. Direct doesn't mean cheaper. It means less negotiation, less customization, and often less actual protection where you need it most. And in insurance, what you don't have covered is what kills you. Deadly mistake number 3, the D&O blind spot. Now, this deadly mistake is the one that keeps me up at night for my clients because it's about your personal assets. Here's something that most founders don't realize. When your startup gets sued for decisions you're making, they don't just sue the company. They sue you personally. The lawsuit names you, the CEO, the CTO, the CFO, whoever made the decision. And that means your house, your savings, your kid's college fund, it's all on the line. Without D&O insurance, the personal assets of key decision makers are exposed. And in a fast-paced startup environment, when you're making quick decisions to stay competitive, mistakes can happen. Company leaders can be held personally liable for those decisions. So, when do you need D&O? The answer is as soon as you have investors or an active board of directors. Not when they require it, as soon as they exist. I often hear the same excuses all the time. We don't have a formal board yet. Investors haven't required it. We'll get it when we raise a Series A. Here's the issue. D&O insurance is a claims-made policy that often will exclude claims for the acts that took place before the policy's inception. What that means is that if you made a poor decision prior to buying the policy and that decision later gives rise to a claim, you're not covered. What could go wrong? An early employee claims you misled them about equity value. An investor alleges that you made fraudulent claims in your pitch deck. A customer sues over a data breach and they name you personally. Here's the thing, nearly 40% of US companies face employment-related lawsuits over 5 years. That's not a small risk. It's almost a coin flip. D&O isn't just when you have a fancy board, it's for protecting yourself from the first day you make decisions that affect other people's money. Your investors' money, your employees' equity, your customers' data, all of it. This is why we specialize in working with tech founders. We help you understand these exposures before they become problems, not after. All right, those are the 3 deadly mistakes, but I promised you 2 bonus mistakes that we see all the time, and these can be just as costly. Let me walk you through them quickly. Bonus mistake number 1, thinking first time is fine. Here's an interesting pattern. Only a handful of first-time founders get insurance early on, but 2/3 of repeat entrepreneurs make insurance integrated into their early growth plans. What's the difference? The repeat founders learned the hard way. I'll give you an example. 2 founders, 2 different companies, both get hit with claims from early employees alleging their equity compensation was too low. Both claims were eventually thrown out, but defending them cost over $50,000 each. Insurance would have covered all of it. Serial founders budget for insurance from day one because they've already paid for that $50,000 loss out of pocket. First-timers learn it the expensive way, the hard way. But you don't need to be in that second group. And bonus mistake number 2, skipping coverage types you don't think you really need. Here, you're assuming certain coverage types don't apply to you yet, so you delay or you just don't get them. I hear it all the time. We don't need cyber insurance. We're pre-revenue. We don't have customer data yet. However, cyber is more than theft of data. It's about system compromises, money frauds, ransomware, and so forth. Cyber is a foundational issue. The next one I hear all the time is around employment practice liability, or EPLI. And the response is, oh, we have that in our PEO. I get it, you think you have that, but I've reviewed several PEO contracts that include EPLI, and here's the problem. Many of those policies have a $100,000 retention. That means you have a disgruntled ex-employee and they sue you. You're forking over $100,000 first before your PEO's insurance company pays anything. Think this through and investigate what you actually have from your PEO. Better yet, send me your PEO's policy and I'll tell you what it has and what it doesn't. It often makes sense to buy your own coverage with a low or no deductible. Final mistake is not having a business owner's policy or a BOP policy. You may be a virtual company or working from a co-working space or out of your apartment, but a BOP policy will provide 2 critical coverage elements. First, general liability insurance. This is your basic slip and fall lawsuit protection that every contract you'll enter into will require. The second part is property insurance. While you may only have a few laptops, it's important to understand that your homeowner's policy will not cover business property, including those laptops. A BOP is cheap and it's excellent protection. So let's recap real quick. Deadly mistake number 1, getting blindsided by an enterprise contract insurance requirement. Deadly mistake number 2, falling for the cheap insurtech trap and ending up underinsured. Deadly mistake number 3, skipping D&O and putting your personal assets at risk. Plus those 2 bonus mistakes about learning from others and not waiting on certain coverage types. Look, insurance isn't sexy, I get it, but it's the difference between a setback and a shutdown. If you're a tech founder and you want to make sure you're actually protected, not just checking a box? Then click the link below in the description box and let's get started. We'll have an honest conversation to help you unravel the issues and get you started in the right direction. Remember, experienced entrepreneurs know they need insurance. Don't wait to become experienced the expensive way. Thanks for watching. I hope you found this valuable. If you did, give it a like and subscribe. Thanks.